Hello and welcome back. Bonjour, Francois.
Hello, Mark.
Nice to see you and thank you for joining us as ever. Let's talk about the geo-macro, geo-global events of this weekend before we start talking about markets. Now, I had titled this video New World Order. I'm not quite so sure if it is anymore. After the speech from Sir Keir Starmer yesterday, he seemed to be saying, yes, Europe needs to do the heavy lifting, but he didn't row back on the traditional relationship between Europe and America, as if he's trying to hold America back into the fold. He said, America is and remains our closest ally. What are your thoughts on that?
I would say that he couldn't say anything else. And, it's diplomacy, it's logical. You have events and you have what diplomats are saying. The events are very clear. Last week was not only the weekend. Last week was about the fact that Trump announced that you're going to have 25% tariff on European goods. Last week was the announcement that you had 10% more tariff on Chinese goods. Last week was about these grotesque situation in the Oval Office on Friday. The reality is that Europe is reacting. They need to react. There is less and less support from the US in terms of being such a big part of the financing of NATO. So there is a reaction. And I think that the UK Prime Minister, could not say anything else than what he said, because at the end of the day, you cannot move from one state to another. Something new is emerging. It's a kind of commercial war that is emerging. You have these new security system that needs to be put in place. It doesn't mean that the US is excluded from it, but it's a different system from the one that we had for the last 60 years.
In that case, what does our world look like in the next 10 years?
It's very, very difficult to imagine what it could be. The point is, and I don't like always to make the reference to that era, but look at what happened in the 1930s. It's look very, very similar in the sense that you have a fragmentation of the world, you have economic war, you have tariffs, you have trade barriers, you have all those kind of the return to nationalist views, and so it looks a bit like that. So it's a kind of order that is going to be more multilateral or regional, or it's something that is going to be different. And if it's multilateral, I don't mean it's the United Nations. It means it's more different. You will have multi-powers that are fighting each other on different fronts. So it's going to be an era where I would say erratic movements are going to be much more important than in the past.
Presumably, if you agree with me, Europe may try and organize some kind of military political system, which would imply that it starts to obviously increase its expenditure on defense. Defense stocks are going up a lot. Is that going to continue, do you think?
I think so. I think that it can continue. It doesn't mean that it's going to go up and up and up and that you don't have consolidation from time to time. But at the end of the day, clearly, and we will have to expect until Thursday, because on Thursday, the European Commission is going to come out with a program of increased military spending. When you listen to Mrs. von der Leyen, it was very clear yesterday. They are going to give the detail by Thursday. So yes, increased spending, but the big question is, how are you going to finance that? Is there going to be a European common debt issue to support? What does it mean in terms of the Stability Pact? Are we going to say that, okay, we exclude the defense or the military spending from the Stability Pact, which more and more is something that is getting to a point where people need to say, okay, it's over with this system. We need to rethink what we want to do in terms of finance and debt. So a lot of factors are coming into play to say that the defense sector in Europe can continue to perform very well because more and more you will have to define European project to produce weapons because no single country can do it by itself. So yes, I think you are right. It's going to continue.
Coming to markets now, 2 weeks ago we did a video called Taking Profits on Equities. And very presciently, you suggested that we should cut back on exposure on equities, we should reduce certainly in the USA and increase in Europe. And lo and behold, what happened? That's exactly what happened, Francois. So So,
Lucky.
and I don't say it enough, do I? However, nevertheless, this has now happened. The markets went, or the US markets at least, went flat for the year. And flat for about 4 months, 4 or 5 months, I think. European markets quite strong. How do you see the next few months panning out?
We entered 2025 and we had long discussion about the market at the end of 24. And I said, okay, be ready for more volatility on the market in 25. We are not going to go up the straight line the way we did in the course of the last 24 months. I think that there are all the reason to believe that volatility is going to stay with us, even more with the environment we mentioned before, because you have a lot of uncertainties concerning these quote unquote new orders about the tariffs, about the economic war, about what Ukraine ceasefire and if it happens one day, peace treaty is going to be. So you have a lot of uncertainty, a lot of erratic movement that can feed into volatility. This is the reason why I still believe that you have some safe havens in the market that you should play. I think that gold, despite the fact that last week it consolidated a little bit, is still an interesting asset. By the way, we have increased our target for the gold price for the end of the year from 3,000 to 3,100, considering the development that we had last week. And I think that Swiss franc remain a value that you need to have in your portfolio. I think that you need to diversify the equity exposure and not to only have AI in your portfolio. This is the reason why we have increased defensive stocks in our portfolio in the course of the last few weeks and few months. And I think that you need to continue. You need to do something and not be on the same themes that work very, very well in 2023, 2024.
So you just mentioned defense stocks. Which are the other sectors you're looking at and maybe increasing in weighting in the next few weeks?
I think that, pharmaceutical remain very interesting. I know that my call on the small and mid cap, which was right at the beginning, has turned negative lately. I still think that you need to try to play the mean reverting process on this asset class. I still think that the trade development, plus the fact that the interest rates, especially in the US, long-term rates have come down quite significantly, is supportive for small and mid cap. So I still think that, and we are looking for an entry point on small and mid cap in the course of the next few weeks. I think that the financial stocks could benefit also for an environment in which, if we need to spend more money in Europe in terms of defense spending, it means that the central bank will have all the reason to keep a very a loose monetary policy or a looser monetary policy. Financial stocks can benefit from that. So I think this is where I would look to invest in for the coming months.
Coming to bonds now. So the US yield curve has flattened again.
Mhm.
How do you interpret that?
I think that you have a lack of visibility in terms of economic development. We all know that it's very difficult to assess what will be the inflationary impact of tariffs. It can be a one-off and then disappear in a matter of a few months. But you also have the elements of immigration and the fact that they want to reduce illegal immigrants in the US, which could have an impact on the labor market in the US, on wages and etc., which would be a longer term impact on inflationary pressures. But I think that the market has reacted to the fact that the policy of Donald Trump for the last 6 weeks, which has been to quote unquote create chaos and not dealing with the economic situation, is not that good for the economic numbers. As we mentioned last week, when you look at retail sales, they were not particularly good. Even if you look at durable good orders, which were published last week, if you exclude transports and those kind of elements, they were not that great. If you look at business confidence, it's not going very well. Consumer confidence, which is essential, is not going very well. So I think that the bond market has reacted to the fact that recent economic numbers point to a slowdown. Look at economic surprises in the US. They have turned negative, which is something that people did not expect. And I think that's the reason why you had such a fall in long-term bond yield in the US over the course of the last few weeks.
Coming to economic numbers now, which are the numbers you're looking at especially?
I think that it's a very tough week this week. You have a lot of things that are going to coming out. I think that the first thing you need to take a look, I would go from the National People Congress that is going to begin mid of the week. It's very important because you need to see if they are really going to go for a stimulus package that can support the economic activity. I think that you need to see if Mr. Trump is going to go ahead with his decision concerning Mexican, Canadian, and Chinese goods, i.e., will there be imposition of tariff or will he make a turnaround concerning this element? And I think that the biggest numbers that I will take a look at is the non-farm payroll on Friday, which are supposed to come around 160,000, a bit higher than last week. I will take a look at the average early earnings because last months were the number were very poor. So we need to see if there is a slowdown on that side. You will have all the PMI indices that will be revised, so it's always important. I will look at the ISM number in the US because they are very important. And the beige book, what the Fed is going to say about the situation, the outlook, and the economic situation in the US economy for the time being. So a lot to take a look at this week.
I think the ISM numbers include services.
You will
Isn't
have
that the most important at the moment as a leading indicator?
It's very important. It's very, you have two elements. It's very, both of them are important. You will have manufacturing plus service. Manufacturing is important because, last month was a surprise move higher than 50, which was not expected by the market. So is it sustainable? Is it sustained? Or was it just a blip? It's very important because for quite a long period of time, the manufacturing sector in the US did not perform well. That's the first element. The second element is last month's ISM number were not particularly good. And as you said, this is the biggest part of the US economy, and it's very important. Is the slowdown going to continue in terms of ISM service? It's a very good question. We will observe that.
Francois, thank you very much indeed, and speak to you next week.
Bye bye.
Bye-bye.